Our next guest has the stock as one of his top holdings. He's Bill Nygren, manages almost $10 billion at Oakmark Funds in Chicago, and his flagship Oakmark Fund has gained over 10% in the last year, beating 97% of its peers. Bill, great to have you back here on In the Loop. And let's start with J.P. Morgan. I mean, are you in J.P. Morgan partly because of Jamie Dimon?
Absolutely, we are. I mean, at Oakmark Funds, we primarily own a stock because of its valuation. And most of the financial stocks qualify as cheap the way we look at them, with stocks like J.P. Morgan selling at about 7 times the earnings that we expect them to be reporting after all the mortgage legacy costs flow through their statement. But these companies today don't have great organic growth opportunities, so they have a lot of free cash flow that they're in control of. And it's more important than ever that we align ourselves with managements that we think responsibly invest that cash flow. And in our judgment, there's nothing better that J.P. Morgan could do with their excess cash than to purchase their own shares at this price. And that's exactly what Jamie Dimon's doing. It
doesn't bother you that he comes out and criticizes Washington and puts himself right in the fire there?
I think if you read the reports to shareholders that Jamie Dimon has written over his term in charge of J.P. Morgan, you see somebody who has been ahead of the pack at understanding what's going on and what's changing in the banking industry. And I think he's right to say that a lot of the important changes right now are because of the regulation that's in place.
We are back with Oakmark Fund Manager Bill Nygren. Also staying with us is Dom and Josh Lipton here joining the conversation. And Dom, you know, we were just talking about Jamie Dimon's annual letter. Now we're getting James Gorman's letter.
That's right. It's Morgan Stanley's turn to put out their annual letter. They just filed theirs. I want to bring you some headlines first because it's the compensation. Let's talk about that because we heard about Jamie Dimon's. Morgan Stanley CEO James Gorman actually got about $10.5 million in terms of comp. That's a 25% cut from 2010. He got about $5 million in restricted stock and about $2 million in shares that are going to be tied to Morgan Stanley performance. Also some headlines that we're getting as we kind of go through this letter. James Gorman saying that Morgan Stanley has made significant progress towards its goals in 2011. He's cautiously optimistic, a pretty decent cliche these days, about 2012. Also that Gorman and Morgan Stanley will seek opportunities in some areas where their peer companies are going to withdraw. So they're going to look for chances to expand their business in places where other banks are exiting, where Morgan Stanley's a leader. So we'll bring you more headlines as they become available. But for right now, this is James Gorman's CEO letter in, not in response.
Right.
Exactly.
So Bill, we were just talking about J.P. Morgan. Would you buy any other of these firms like Morgan Stanley?
We own a lot of the financial companies. Morgan Stanley is one of the names we do not own, but we own Capital One, we own Wells Fargo. There are a number of the banks and financials that we think are quite cheap and are attractive.
Are those the only reasons why you own them? I mean, what else?
Well, when we buy a stock for the Oakmark Funds, there are 3 things we're looking for. We want it to be undervalued, we want to be confident that it's going to grow, and we want management that's aligned with the shareholders. So any of those stocks that we own, we believe meet all 3 of those criteria.
Bill, what I thought was interesting was that you were able to outperform the market and not hold Apple. Is that right? It almost seems like these days you have to own Apple.
No, that's not right. We do own Apple at the Oakmark Fund. A lot of people think because we're a value fund, we shouldn't own companies that are growing at above average rates. But we've owned Apple for about 3 years, and through most of last year, Apple, if you adjusted for its cash, it was only valued at 10 or 11 times earnings. All you needed to do to own Apple was believe it was at least an average company. So it happens to be a much faster grower than we're typically able to buy.
So you must be happy that they're buying shares back and they're issuing a dividend.
Right. We think, across the S&P, one of the most important things now for investors to focus on is the high-quality balance sheets and the strong excess cash flow position these most all companies are in today, only paying out about 25 to 30% of their dividends. So managements have a lot of control over incremental growth that they can create through what they do with that cash. And most of our companies are increasing dividends, they're repurchasing shares, they're making add-on acquisitions. And I think a lot of the people who are negative on stocks today are missing this incremental growth that's likely to come from free cash investing.
Now, Bill, the chips are falling where they are for your portfolios right now. Where is the overweight? Not that you're selectively overweight an area, but as you look at your portfolio, what sectors are the most heavily weighted in your funds?
I think the easiest way to explain that is to look at the areas we aren't invested in. We think bonds are overpriced compared to stocks, and the stocks that look most like bonds are the ones that we think are most fully valued. So in our portfolios today, you see nothing in the utility sector. You see very little in the consumer non-durables, the very stable companies that tend to pay high dividends, and investors have very little concern about potential declines in their earnings. Most everything else we think is undervalued and pretty attractive.
And Bill, it's Josh. Obviously, you're interested in management getting capital back to shareholders, as you discussed. When it comes to buybacks, you've argued they're just as good, if not better, than dividends, right?
Right. I think yield-hungry investors who want to get more in income than they can get in the bond market today have been flocking to the companies that pay out high dividends. But we're just as happy to get that capital back, in fact, more happy when the stocks are cheap, to get that capital back through consistent share repurchase plans.
Right.
And the overwhelming majority of the companies we own in Oakmark are repurchasing shares, and 3 of the companies, Kohl's, Northrop Grumman, and DirecTV, all repurchasing more than 10% of their shares
Bill?
last year.
Thank you. Appreciate it. Bill Nygren of Oakmark